So welcome to our today's session, and I hope you are all doing well. Today we are going to look at the company analysis. This is topic number 3, and it is under equity investment analysis. In our previous lecture, we were looking at industry analysis, where we said that industry analysis is a research or an investigation which is done in an industry sector. And here, mostly we focus on the macroeconomic factors that may affect the performance of an industry sector. It could be the government regulations, the global performance of the economy, the inflation, the exchange rates, the political stability of that country, and many other factors. So today, we're going to look at the company analysis. Now, after you have done your industry analysis, which is more general, now you come to company analysis. And company analysis, it usually entails analyzing of the company financial position, the income statements, at the same time, you look at the management of the company. How is the management of the company performing? And also you look at the competitive strategy of that company. We have said that company analysis, is an investigation in which you look, or is an analysis whereby an analyst will have to look at the financial position of a company as a financial position of a company. Number 2, the company management. Company management. And number 2, the competitive strategy of a company. These are the key areas where an analyst, when doing company analysis, will have to investigate: the financial position of a company, the company management, and the competitive strategy of a company. So company analysis includes the analysis of the company's financial position, the management of the company, and also you can look at the services and the products that the company or the firm offers. Also the products, stroke services that the company offers. How unique are your services or your products? The pricing of your products and services in comparison with the other service providers, or the same, or with other companies which offer the same products or services. So you need to compare, and then you do your company analysis. Company analysis includes analyzing of the company's financial position as products or services, look at the company's management and the competitive strategy of the company. So a competitive strategy, this is how a firm responds to the opportunities and threats of the external environment. Competitive strategy, this is how it's like a survival tactic of that company. How does it respond to the external forces from other companies operating that industry? So in this, it could be in response towards the opportunities. When opportunities arise, does it have enough reserve to make or use that advantage to kind of take that opportunity and maximize on it. And a threat, when a threat rises, does it have enough money so that it can be able to, or enough reserve to cushion itself out of that threat? So a competitive strategy, this is our firm response to the opportunities and the threats of the external environment. The strategy can be either offensive or defensive, depending on the type of the opportunity or threat. So the opportunity and the competitive strategy could either be defensive or offensive, depending on the type of a threat or the opportunity that it is exposed to. Depending on the type of the opportunity or threat that is exposed to. When we are looking at the industry analysis, we look at the 5 points that Michael Porter developed, so that when you are doing your industry analysis, you are to look at the bargaining power of the supplier, the bargaining power of the buyers, the rivalry between existing competitors, and we looked also at the barriers to entry. Again, he also he came up with some points or factors which are able to, or are very important strategies when looking at the competitive strategy of a company. Now, this one, or these points include: number one, competitive strategy point. So competitive strategy. Number one is what we call, when you are the low cost producer, what we call the cost leadership. Cost leadership. Cost leadership. Cost leadership is a competitive strategy which is employed by a firm, and this is where the products or the services of this firm are priced at a very low price, where the products or services of this firm are priced or they sell at a very low price compared to the other same services or products from other firms. Again, we also have another point which is called product differentiation. Product differentiation. This is having or coming up with somehow unique products compared to the same producers in the same industry, coming up with different price, unique features of products compared to the other same producers in the third industry. You can add some more features which can uniquely distinct or differentiate your products from the other producers in the market. So by doing this, probably you could have an higher competitive advantage compared to other firms operating in that same industry. So we have said that the low cost strategy, this is where or the firm seeks to have the lowest cost of production in its industry, offer the lowest prices, and by doing, when it's offering their products at a very low price, then it must again generate huge volumes of that products to sell at low prices so that it can generate enough superior return by selling a lot or by producing a lot of volume of same products and selling them. But if it's selling at a low price, again, it does not have enough products, or it does not enjoy the economies of scale, then it could not be really generating enough return out of that strategy. But again, you find that we have what we call predatory pricing. Predatory pricing. This is whereby a firm opts prices, it's going to price their products at a very low price, hoping to drive out competitors. And then later on, when it is able to push out the other competitors out of the business, again, it will later on increase the price of their products. This is where the firm aims to drive out of competitors and later increase the prices. So the strategy can be defensively to protect the market share, or offensive to main market share. Remember when we were saying that competitive strategies they can either be defensive or offensive. Now, when it's employing the cost leadership strategy, it can be either defensive or offensive. It can be defensive, whereby it is trying to protect its market share. When it's trying to protect its market share, or again, it could be offensive when it's trying to gain the market share, probably when it's doing the predatory pricing, that is, it's pushing out some competitors because their products are selling at a very cheap price. But again, later on, now by doing that, it will, by pushing out the other competitors, is gaining a market share, a huge market share. It could increase from 50% to 75%. Later on, when it has been able to gain enough market share, it's again going now to increase the price to either the previous price or even more. Now let us look at the other. Also, you are saying that there are another strategy is differentiation of products. So the firm's products and services should be distinctive in terms of their quality, even delivery. I think these are some features you add to your product and services. It could be in their quality. It could be even in your other terms like delivery. You could, if you can, somebody can order and you deliver at their doorstep. That's another feature you can add to your service or to your products. Now, by doing this, you are going to again to gain some market share because your products will be of higher quality, and probably these services like for the delivery. If somebody orders a product and then you are deliver it to our doorstep, now it's more clients will like to have that kind of cost. They do not have that other expense of shipping or their logistics part of it. It's not, they don't, it's not a cost on their side. So that's, by doing that, you are going to gain some market share. So for success, the firm cost of realization must be less than the price premium buyers place on product differentiation. So the price premium should also be sustainable over time. So for you to have this product differentiation, you must have a proper research of the business. That's doing market research and the creative personnel to increase the creativity and innovation of your product. So when you are doing company analysis, it should include the following elements. Company elements, including the company analysis element. Included in company analysis. So number one is the firm overview. What we call number one is the firm overview. The firm overview. And the firm overview includes the information operations, the governance, the management of the company, the strengths and the weakness of a company, And in looking at the strengths and weakness of a company, you do what we call S or T, whereby you look at the strength, weakness, opportunities, and the threats of that firm. When you are doing your company overview, first of all, you look at the company's governance, you say governance, management, you look at its operations, its general or its main operations, their productions. And again, you look at what we call the company weakness and strength. By doing that, you use this criteria, which is weakness, strength, weakness, opportunities, and the threats of that firm. That's when you are doing the firm overview. And then you look at number 2, what you call the industry characteristics. Industry characteristics. Remember, your firm or your company is operating under an umbrella or a certain sector of industry. It could be in the financial industry where you are offering financial services. At the same time, now you should look at the features or the characteristics of that industry in which your company or your firm is going to operate or is operating under. Number 3 is the demand of your services and products, what we call the products demand. The product demand. So you need to have your market research. This is done by market research. You need to do a market research so that you can enable to examine or determine the demand of your products. Again, after you have been able to come up or to know the demand of your products, then you can do what we call the product cost. Number 4, what we call the product cost. This is the cost of your products. Product cost. At what price are you going to cost? Or it includes the cost of production, of the cost of production of your product, and from there you can also be able to price your products accordingly. And then the other point is pricing environment. After you have done the cost of your products, also says the pricing. Again, here you are going to have another research. If there's another firm offering the same products, then you need to understand how they are pricing, or with the price at which products are selling, so that you don't really overprice you underprice your products. So you can come up with an equilibrium to know at what price you are going to have your product sell at. So the pricing. And then number 6, you need to use the financial ratios. This is to enable you to do analysis of your efficiency, profitability, and also even leverage. We have different financial ratios. You can want to use them. And from these, from using of these financial ratios, you are going to enable you to do a comparison with the performance of the other companies over time. I've said that financial ratios, they are different. There are several of them. Some of them, they measure the performance of the company, the efficiency of the company, the profitability of the company. Some of them, they also the leverage level of the company. And by doing this, the results you want to compare with other companies in the field over time, so that you can see the performance or the efficiency of your company. And then from there, the way also to include the projected cash flows or the projected financial statements and the firm valuation, what we call projected financial statements and firm and farm valuation. Projected financial statements. This will be the projected income statement, where you are going to take into consideration the expenses. You are also to see the income. Also, you are to have a projected cash flows. Share of money will be coming in and going out of the farm. Also, the financial position of the company. And do a farm valuation. Farm valuation is done with different formulas. Probably you will be doing evaluation of your equity valuation. You will be doing what we call the dividend valuation model. There are several methods and formulas to do that we are going to tackle again in our subsequent lessons on how to do your farm valuation. So these are the elements which are included in the farm or in the company analysis. Number one is the farm overview, industry characteristics, the product demand, product cost, pricing of environment, financial ratios, projected ratios, financial ratios, and projected financial statements, and farm valuation. So by doing this, a farm's return on equity, which we call ROA, you are going to know your farm's return on equity. Probably most of the time is a function of profitability. So a function of profitability is a function of profitability. It's a function of profitability, total assets turnover, total assets turnover, and financial leverage, or what we call debt, and financial leverage, or what we call debt. So the function or return on equity is equals to profitability as a function. Profitability is equal to net income divided by sales. So it's equal to net income divided by sales. You multiply it by total assets turnover. Total assets turnover is equivalent to sales divided by total assets is equivalent to sales divided by total assets. You multiply by the financial leverage or debt, which is equal to total assets. You divided it by the total equity or the total shareholders equity. So it's equal to, or it's that the financial leverage is equivalent to the total assets divided by total equity. By cancellation, return on equity is equivalent to net income divided by total equity. Return on income is equivalent to total income. Return on equity is equivalent to total net income divided by the total equity. Now, the return on equity is part of the farm's financial analysis. It's part of the financial analysis, and it falls under the financial ratios. We say that we have the ratios of profitability, the ratios financial leverage, which is the debt, and the total assets turnover, which is more of the efficiency of the company. Now let us do a comparison between a stock and a company. Comparison between a stock and a company. So comparison between company versus stock. Company versus the stock. So you have different companies and different types of stock. And let us look at the first category of where we have the growth companies versus the growth stock. Number one, the growth company versus stock. A growth company versus a growth stock. So we find that a growth company is a company that consistently grows by investing in projects that will generate growth. This is a company that consistently grows by investing in projects that will generate growth. So you find that it's a company where the management has the potential of selecting projects which have a positive NVP or an NVP which is viable for a certain projects. NVP is the net present value. At the same time, you find that so a growth company is a company that grows constantly by investing in projects that generate growth. And it's characterized by the management which selects projects which have a viable NPV. And you find that the growth stock is a stock that earns higher return over time over other stocks in a similar risk profile. This is a stock that earns or generates higher return or higher rate of with other stocks in the similar risk profile. Number two, we have what we call the defensive company and the defensive stock. Defensive company versus defensive stock. Defensive company versus a defensive stock. A defensive company is a company that earns or its earnings are relatively unaffected in a cycle downturn. When we are doing company analysis, we see a company as a business has a different cycles. So we find that every cycle or every stage has its own characteristics. And we say that when a company is defensive, its earnings are not really affected by the cycle of the business. So meaning that when the business is going down, his earnings will not be really affected. That's meaning that if the business is going down, it will relatively, its earnings will be consistent, or even if they will have to increase, but they are not going to fall as the business cycle falls. Again, another, it reflects the products that we need versus our wants. You know, you have needs and wants. So the defensive company is a company which has or which is a producer or a player of products which are more of our basic needs and not our wants. Things that you cannot do without them. The economy, if the economy is going down, but that you still need to have those basic needs like food. So the earnings of that company are not really affected. And then the defensive stock, a defensive stock is a stock whereby its value relatively downturn. Okay, it's again, it's its value or its earnings is not really affected by the business cycle downturn. The value of that stock is not affected by the cycle downturn. Then you have number 3, another comparison between a company and a stock. You have speculative company and speculative stock. Speculative company versus speculative stock. Speculative company versus a speculative stock. So we find that as a speculative company is a company that invests in business with an uncertain outcome, or rather businesses which are very risky. A speculative company is a company that invests in business with an uncertain outcome. So the companies or the company assets are very risky, but the assets have the potential to generate higher returns. It invests in uncertain business with uncertain in business which are have very high risks, but also they have the potential to generate higher returns. For example, in the business of diamond mining and also oil exploration. Diamond mining and oil exploration. Also, we have what we call a speculative stock. This is a stock that has a potential for higher return, as well as potential for considerable losses. It has a potential for higher return. This is a stock that has a potential for higher return compared to the other stocks, but at the same time, it has an equal potential of generating higher losses. Lastly, number 4, you look at this cyclical company versus stock. Cyclical company versus cyclical stock. As a cyclical company versus cyclical stock. So this is a company whose earnings are affected relative to the business cycle. This is a company whose earnings, a cyclical company is a company whose earnings are affected with relative to the performance of the business cycle. Now, this one, which is, we say that a defensive company, its earnings are not affected by the business cycle. We give an example whereby a company that is a player in the sector or in the production of needs or products which are of the basic needs to human beings or to consumers. And then here now, it's affected by the relatively to the business performance or the business cycle. An example is a company that is a player in the production of things which are luxurious or wants. At the same time, a cyclical stock, it is a stock that will, or its value will move with the market or in the market in relation to the business cycle. It's the value of the stock, it's affected by the business cycle. So it follows it follows the trends of the business cycle or the performance of the business as it is. So again, we say that in the company, we had what we call the competitive strategy. And we said one of the competitive strategy is cost leadership and product differentiation. And we said that the cost leadership is whereby you are being the lowest cost producer of the good, and product differentiation is probably you are adding more features or to your product or to your services that increase or rather which are going to increase its attractiveness of the farmer's product so that it will command a premium price in the market. It will command a premium price in the market. So these are the factors that determine the company competition. Factors that determine the company's competition. Number one is the cost leadership. These are the same factors which we said that the competitive strategies of a company. So factors that determine the competition of a company, that determine company competition. Number one is the cost leadership. Number two is the product differentiation. Number three is what we call the focus. And we say that cost leadership, so the cost leadership is whereby you are being the lowest producer or the lowest cost producer of goods and your services. The lowest cost producer of your goods and services. And the product differentiation, we said that is the addition of features to your products or to your services so that they are attractive, so that it will enable you to command higher price premium. And then the focus is now the employment of one of these two strategies within a particular segment of the industry in order to gain a competitive advantage. Focus, now this you employ one of either the cost leadership or the product differentiation in a particular segment in an industry so that you can gain the higher competitive advantage. And we say that Michael Porter is the one who developed these two competitive, or these three competitive strategies. And it's again, we see the same guy who developed the other factors that determine the industry competition, which we looked at. But again, we can highlight on them the factors that determine industry competition. Is the ones by Michael Porter. Number one, we said is the threat of new entrants. So that the easier it is to enter the business, the greater the potential of competition, because in that business, so what we call the barrier of entrance. Barrier of entry or entrance. So that if it's easier for investors to get into the business, then there's a greater potential of competition, because it will be saturated, or rather it will have more players in that industry. We see that most of the barriers of entry, they include high startup costs, or rather what we call the large capital outlay. It could be government regulations, different government regulations, and also some economies of scale. They help or they limit competition. Number two, we said another factor is the rivalry between existing companies or no, yeah, all players. So rival between existing competitors. Rivalry between existing competitors. And we say that the rivalry is very high when firms of equal size compete in an industry. Firms of the equal size compete in an industry. So slow growth leads to competition when firms fight for the market share. So when these equal-sized companies are competing in the industry, they have this, probably they have the same market share. When they have the same market share, and their growth is slowed down because of the share that, or they share the existing market share. And also it's characterized by high fixed cost, leading to price cutting as a firm try to operate at full capacity. So this is probably a company an existing competitor may decide to employ either the cost leadership strategy so that it will enable it to have gain market share so that it can operate in full capacity. Another threat that we said is the threat of new product substitute. Number three, threat of product substitutes product. Product substitute product. So the profit potential in an industry is limited when many substitute products exist. So when many products exist and you find that the switching cost from one product to another product is very low, you find that the profit potential in an industry is really very limited. So the availability of substitute products restrict the price a firm can charge its products. Then when there's high levels of competition and low profit margins for more commodity-like products. Find that by doing that, because there is we have different product substitutes in the market. We say that, and again, we find that the switching cost, this is the cost you switching from use of one product to another or one service to another is very low. So you find that the profit of an industry is affected, and so the profit, or rather we have low profit margins for more commodities in that industry. Another factor is the bargaining power of the buyers. Bargaining power of buyers. So find that a limited number of buyers or a higher concentration of buyers relative to the seller's prices or relative to the sellers, it's going to place the buying firms in advantageous position of sellers. So meaning that the buying firms have a significant control over their prices. We say that this is a bargaining power of the buyers, the consumers of that product. And we are saying that, so when the buyers are, or the high concentration of buyers relative to sellers, this places the buying firms in advantageous position of sellers. Probably now it's going to price their products accordingly, and by doing that, it's going to generate high profit margins. And the last point we said is number 5, it was the bargaining power of sellers or suppliers, sorry. The bargaining power of suppliers, bargaining powers of suppliers. So we find that a limited number of selling firms places the firms have, when there are a limited number of them, that's when they have they can have this bargaining power if they are very few and scarce. When they are very few and scarce, then they are in an advantageous position compared to the buyers, because now they are going to have, or they are going to price their products higher so that they can have their profit margins are greater. Now, when you find that the the suppliers are concentrated in an industry, now it's advantageous to the buyers because they can switch from one supplier to another. Again, we find that when the suppliers are concentrated, also their prices or the pricing of their commodities is relatively low. It's relatively low. So now in doing company analysis, there's 2 approaches. You have either can use the bottom up or the top down approaches. So you've seen the approaches of forecasting of company analysis. Number 1, we said it can either be top down model or bottom up. The top down, or it will be either bottom up model. The bottom up, the top down model. And the first where we have this, the top down. This analysis begins with an analysis of broad economic trends. You have the broad, it looks at the broad economic trends. Broad economic trends. So that's we said that in our we say that industry analysis, we look at the macroeconomic factors. And now when you are doing the company analysis, when you start with the bottom up, the top down approach, I'm sorry, now you begin looking at the broad economic trends. So you find that after an industry that is expected to perform well is chosen, that's after you have done your industry analysis and you have been able to identify a specific industry that an investor or you're willing to invest in, or to be a part of that industry as a player or a participant. So after you have chosen the expected company and an industry, which is you see is going to perform well, now you look at the most attractive companies within that industry. So you look, first of all, you start with the industry analysis. So you identify the industry, and then you look at the company. Then you look at the company that is attractive in that within that industrial sector. So the top-down forecasting, it moves from international and national macroeconomic factors to industry forecast, and then individual company and asset forecast. So this one, it moves from the international and national macroeconomic factors, which we look at, you analyze them, and then you look or you choose an industry which you are going to operate in. If it's you are going to operate in the manufacturing industry, then from there, again, you look for the most attractive company. This is the most performing industry to be, it would be a financial industry or a manufacturing industry. And then from there, look at the most attractive company in which you are going to perform at. And then you look at the financial forecast or asset forecast in the company. Look at the asset forecast. Look at the asset forecast in that company. So you find that it is the top down approach. Or rather it has 3 steps. The first step, you forecast the microeconomic factors or influences the company. You look at the fiscal policy. You can also look at the monetary policy. The monetary policy is the one which is established by the central bank of a specific country. And then from there, you can determine the industry, as we said here, by the industry effects, the performance of, you have to look for the well-performing industry or the industry that you forecast that in the near future or is going to have, or the performance of that specific industry is going to be higher. Probably it will be the industry, maybe the health care provision services, probably in terms of, if you see that the industry has an high potential performing well or high potential of an increase in their profitability. So that's, you identify a specific industry, and we see the industries that they are very several. Can be a financial, health sector, the energy industry, the manufacturing industry, the tourism industry for the offering of services, to identify the specific industry and its effects, and everything that encompasses that industry. And then from there, you look at the political regulations. If you are, that's now, if you want to be a player, you identify the company, and then if you have to, if you are going to be a player in the same industry, and you have been able to select the most attractive company that you are going to invest in, then now, for example, a company is like, if you have been able to identify the industry as maybe the industry of tourism. Tourism, as it could be in travel, it could be in hotels and accommodation. You look, if now you have been able to identify either you want to specialize in the travel business or company, and then you look at the political, the policies and the regulations that encompass that kind of company, and also specifically in that industry that you are going to operate. The tax, if there is any other political regulations, which probably can, some of them they could be advantageous, or some of them they could be disadvantageous to a player. You look at them, and then you have your forecast. Another approach is the bottom-up approach. The bottom-up approach is where now it's like a reverse of the first top-down approach. So in the bottom-up approach, the analysis begins with the criteria such as the firm's business prospect, the quality of management. So here now you look at the business of a company, business company of the prospects, potential of the business. Also look at the quality of management, because the management, they play a very key role, and also the expansion or the growth of a company. So when the quality of the management is of or is top notch, then the performance of that company is projected to grow steadily. And also if the growth, and by that it means that the profitability of the company also, they're going to grow, thus generating enough revenue for the stakeholders. So first of all, you need to look at or rather you look at the quality of the management. You study the quality of the management, and then you do what we call asset class allocation. You determine asset class allocation, determine asset class allocations, and then the portfolio managers may attempt to identify the most attractive securities within the asset classes. And then the asset or the security analysts use the model valuation for securities to identify those that appear undervalued in what is termed as bottom-up approach security analysis. So the bottom-up focused approach aggregates focus at a micro level to larger scale focused under specific assumptions. So you do the math, and then you work out with assets plus allocation. Then you do the security analysis. Yes, security analysis. By valuations, we have different formulas to evaluate securities, and this is done by the portfolio manager of that company. So you find that the bottom-up approach, it is, or rather it aggregates the micro level aspects to a larger scale focus, but under specific assumptions. It aggregates the micro level aspects of a company to a larger scale focused under specific assumptions. And then we have a third approach, which can be called is a hybrid analysis or approach. Now this involves a combination of the two. That's the bottom-up approach, and the bottom-up approach encompasses as a combination of some elements of both the first two approaches, either the bottom-down and the bottom-up and the top-down approach. The bottom-up or the top-down approach in determining the analysis of that company. Also, let us look at what we call indicators of quality earnings, indicators of the quality earnings, or rather quality earnings. quality earnings. So this involves the investigation of the accuracy and detail of a firm's disclosures of the financial information. So quality earnings here is involved an investigation of the accuracy and detail involves the investigation of the company's accuracy and detail of the firm's disclosure firm's disclosure of its financial statement or books of financial statements. It involves the disclosure of financial statements of a company and the details and the accuracy of that or of those financial statements. And so the financial statements may include the firm's income statement. So this include the income statement, may include the balance sheet, note statement, the balance sheet. Then also it will be the cash flow. The cash flow of the company. They include the financial statements, include the income statement, balance sheet, in cash flows, and also what we call the notes of the financial statements. You find that some of these financial statements, they come or they are accompanied with some notes. So also an investigation is done in those notes. So we find that the quality earnings issue is reflected in a firm's stock price, with firms with more transparent earnings having higher market values. Find that now the quality of earnings, this is an issue which is reflected in the market, is an issue which is reflected in the company or in the firm. Firm is market. The firm is market stock price. Find that a company or a firm which has transparent earnings and their financial disclosures are done in accordance with the international financial reporting standards, they have higher market values to theirs or relative to the stock. They have higher market values, the stock. So some of the what are the indicators of quality earnings? Indicators of quality earnings. Indicators of quality earnings. Indicators of quality earnings. Number one is the premature recognition of income. Premature recognition of income. After the premature recognition of income. Number two, what we call reclassifying gains and non-operating income. Classification or reclassifying gains and non-operating income. And number three, we have expense recognition and losses. expense recognition, then number 4, we have what we call amortization, depreciation, and discount rates. Amortization, depreciation, and discount rates. Then we have lastly what of balance sheet issues. Of balance sheet issues. Of balance sheet issues. So those are the indicators of quality earnings. Number 1, you have the premature recognition of income, reclassifying gains and non-operating income, expense recognition, and also the recognition of losses. You have the expense. We have the expense. Sorry, what we call expense recognition and losses. Then we have amortization, depreciation, and discount rates. And then we have what we call off-balance sheet issues. Now, let us look at number 1, where we have the premature recognition of income. So you find that firms have used a variety of techniques to justify the recognition of income before it traditionally could have been recognized. And these may include recording sales and billing customers before products are shipped or accepted, and bill and all schemes in which items are billed in advance and held for future delivery. These schemes have been observed declines in operating performance and boost reported revenue income. So they boost the reported revenue income. We say that these may include recording sales and billing customers even before the products are shipped or accepted, and you can bill and also a product which is be delivered later, but you can recognize that as a premature income, because if it will be delivered, then and the income is, or if the bill is paid, then that is your income. So you recognize that as a premature income even before the delivery of those goods, but you have been able to bill them and you hold them. Then number 2, you have the reclassification or reclassifying gains and an operating income. So you find that firms occasionally have gains or income from sources that are peripheral to their operations. This means a company that can have some source of income or gains which are not really encompassed in their own operative business. And we say that this, when you only classifying these items as operating income, we distort the results of the firm's continuing operations, often hiding underperformance or the decline in sales. We say that a firm occasionally have gains or income from sources that are peripheral to their main operations. And then the reclassification of these items as operating income will distort the results of the firm's continuing operations. Then probably it may hide the underperformance may not show the true performance of the company, the true performance of the company. Number three, we say the expense and losses recognition. Then that some companies, they delay the recognition of expenses. So by delaying the recognition of expenses and capitalizing expenses and classifying operating expenses non-operating expense is an opposite approach that has the same effect as reclassifying gains from resources and then increasing the operating income. So if you don't really recognize losses and well and the expenses well, you may find that as now whereby you are inflating, you will be inflating or yeah, you will be inflating your incomes. You will be inflating your income. That is if you don't recognize the expenses and losses of your company in accordance with the standards which are set. So you find that a company which has or which which recognizes expense and losses according to the standards which are provided, the international financial reporting standards, they or they have good indicators of their earnings when someone is going through their financial statements, when someone is going through their financial statement. So you find management also has a discretion in creating and estimating reserves that reflect expected future liabilities such as bad debt, reserves or provision of expected litigation losses. So you find the management also has a discretion in creating and estimating reserves that reflect expected future liabilities, and these future liabilities could be either a legal process expense which is going on in court, what we call litigation process, and also it could be either what we call the bad debt reserve. It could be a debt which is bad, probably will be written off in the future. Also, it could be a provision of what we call litigation process. This is in case there's a legal proceedings in the court of law. In case there's a legal proceedings in the court of law. There's a legal proceeding in the court of law. And number four, you have the amortization, depreciation, and discount rate. So you find that management has a greater deal of discretion in the selection of amortization and depreciation methods. You find that you have different depreciation methods and also amortization methods. Depreciation methods, they could be straight line. It could also be another one. We have the balance method. So a company or the management of a company, that's why you say that the management, the quality of management also determines the performance of the business. When the quality of management is high, so the performance of that business goes up, therefore improving the profitability of that company. So you find that the management of the company is the one which is involved in the decision making of the operations of the company. So it must be of high quality, or they must have the prerequisite acquired qualifications. And you find that, so the management is the one which is going to decide which depreciation method we are going to use. So it's also as well as it's the one which is going to select or to choose the discount rates, the discount rates to determine the pension plan obligations. Also, you have different pension plans, pension plan obligations. So we can find that these decisions can reduce the current recognition of expenses. So depending on the method of amortization, depreciation, also the discount rate, and also the pension plan that the management is going to choose, they are going to reduce the current recognition of expenses, in effect deferring recognition to later periods or later times. So you find that the method which is going to be used for amortization or depreciation of assets, also the method that is going to be used as a discount rate when it comes to pension plan obligations, it's going to affect the current recognition of expenses. Probably they are going to be deferred in the future periods. They will be recognized in the future periods. So find lastly the off-balance sheet issues. Find that the balance sheet may not fully reflect. Find the balance sheet which essentially indicates the assets and the liabilities and the equity of a company. It may not fully reflect the assets and liabilities of the firm. So you find we have some special entities, what we call the special purpose entities. They can be used by the firm to increase sales or to obscure the nature and value of assets or liabilities. Also, you have the scenarios of lease. The lease can be structured as operating rather than, you have two types of lease. So it could be an operating lease or a financial lease. So it can be one type of a lease. It can be classified or categorized wrongly, and again that's going to affect the recognition or rather the accuracy of that financial statements, therefore their quality of earnings. Having looked at the quality of earnings, now let us look at the factors, or rather some factors that could, or they are like red flags, or could signal future negative surprises or failures of a company. Factors that may signal future surprises or failures. Of a company, factors that signal, but these are risk factors that may signal future surprises to a company. Number one, if there is poor quality of accounting disclosures, such as segment information, where you have the issues of acquisitions, measures, accounting policies and assumptions, and lack of discussion of negative factors. So number one of the risk factors that may signal future surprise says that actually is the poor quality of accounting. Poor quality of accounting. Poor quality of accounting. So number one, we have poor quality of accounting. And number two, the existence of the third-party transaction. Existence of third-party transaction. Existence of third-party transaction is where maybe the company is either a subsidiary or is in a joint venture with another company. So when you find some existence of some transaction within these that parties. Also, there's existence of excessive officer, director, or employee loans. So number 3, where existence of excessive officer, an employee, or director loans. Director loans. Existence of excessive officer, employee, or director loans. Also be what we call high management or director turnover. High management or what we call director turnover. High management turnover or director turnover. So also you have excessive pressure on company personnel to make revenue or earnings targets. So this is whereby there's pressure from either the management so that to the company personnel to make revenue or meet targets, that's earnings targets, particularly when combined with dominant aggressive management team or individual. Some of these people, because they have to meet the targets which they have been setting this pressure, you may find them going as far as carrying out their business in a very unethical manner, So you find there's excess of pressure from the personnel to meet targets. You have excessive pressure, to meet targets. Pressure on, please can see company personnel to meet earnings targets. Excessive pressure on company personnel to meet earnings targets. So if I also other factor, it could be the issue to deal with auditing, where you have the material and audit services performed by the audit firm. Material and audit services. So material and audit services. Performed by audit firm. By the audit firm. So you find that also when the management or the directors, their compensation is tied to the profitability or the stock price. Also another point is where the management, that's number 6, you can write, where the management or the director's compensation is tied to profitability or stock price. Also, you can add also another point is when the economic industry or company specific pressures on profitability, such as loss of market share or declining margins. The company economic specific or industry pressures on the profitability. Also, when the management has a pressure to meet debt covenants, management pressure to meet debt covenants is also one of the most, well, most of when a company has an high leverage, so you can add here also management pressure, management pressure to meet debt covenants, to meet debt covenants. Dates to meet the debt covenants when a company is highly has an high financial leverage or it's highly geared, when the company is very geared. So as part of the assignment, you can go and discuss or explain 5 factors that will influence the cash flow forecast in various industries in Kenya. Explain 5 factors that could influence cash flow forecast in various industries. This is part of, could be take this assignment. Explain 5 factors that could influence cash flow forecast in various industries in Kenya. All 5 marks. You can also look at, describe the characteristics of various stages of an industry life cycle. I think that's an issue or a topic that we tackled when we were doing at the industry analysis. See, you have the embryonic stage, the growth stage, we have the shakeout, the mature, and decline. So at every stage, it is as its own characteristics. You can go and describe them. So you can discuss following concepts as used in company and industry analysis: low cost strategy, also what we call the product differentiation strategy. I think again today you are being able to cover that. Also, you can go and explain 4 externalities that could affect the sales and profits of an industry. These are 5 external factors that can affect the profit and sales of an industry. Also, you can go and discuss the 5 points. All of strategic analysis of an industry involves analyzing the competitive forces that determine the possibility of economic profits. So again, you can go and look at those 5 competitive factors which were developed by Michael Porter. Again, we tackled in the industry analysis, also in the company analysis. So you had an overlook at them, an overview. So you can go and look at those factors. Those you can go and define the term peer group. Again, when we were looking at industry analysis, we came across the term peer group and discussed the steps followed in forming a peer group. Define the term peer group and discuss the steps followed in forming a peer group. Also, you can go and look at, or you can go and explain the factors, that affects the sensitivity of a company to the business cycle and the uses and the limitations of industry and the company descriptors such as growth, defensive, or cyclic. Growth, defensive, or cyclic companies. You can also go and discuss factors that an investor could consider while performing an industry analysis in a particular company. 4 factors that an investor could consider while performing an industry analysis of a particular company. Discuss 5 factors that an investor could consider while performing an industry analysis for a particular company. We want to look at those questions. They are very important. Also, they are going to help you do a revision on these 2 topics of company analysis and industry analysis. company analysis, and industry analysis. So in our next lecture, we're going to look at what we call equity valuation process. Equity valuation process. And after then we are done with the equity valuation process, we are going to look at the dividend model of valuing an equity. So next we are going to look at what we call equity valuation process. We call equity valuation process. Equity valuation process. You have the notes, you can go and read. So the next time when we are going to have our next lecture, we're going to look at that, an overview of equity valuation process, and now to evaluate an equity, different types of value. You have the investment value, the fair value, the market value. We're going to look at those types of values. We want to know what is the pricing of an equity, application of equity valuation, application of equity valuation, application of equity valuation, and also we are going to look at choosing or rather how to choose the appropriate valuation approach for an equity. We have, as it, we have several valuation approaches. It could be of a dividend growth and dividends. We have different types of dividend growth models. You have a single period, a multi period. You have the H model. You have the H model. The zero growth also is another model. So I want to choose or to look at factors that are going to enable us to choose the most appropriate valuation model, the most appropriate model. And then when we are done with that, I think we are going to proceed to another topic, which is called discounted dividend valuation. Discounted dividend valuation, now which is very highly tested in our examinations. So till we meet next, go and do a revision of company and industry analysis, and also have an overview of valuation of equity valuation processes. Equity valuation processes. Now this marks us the end of our session today. Have a nice time.